Hello, everyone. My name is Øystein Wagen. I'm an equity research analyst at Fearnleys Securities, and I would like to welcome you to Capital Link's Shipping Sector webinar series. In this series, we have the opportunity to delve into the latest trends, challenges, and opportunities shaping the shipping sector. And today's webinar will be focusing on crude and product tanker segments. With us today, we have Mr. Paolo D'Amico, Chairman and CEO of D'Amico International Shipping. And Mr. D'Amico is also the current chairman of INTERTANKO. We have Mr. Lars Barstad, CEO of Frontline Management. We have Ms. Lois Zabrocky, CEO of International Seaways. We have Mr. Ted Petrone, Vice Chairman of Navios Maritime Partners. And lastly, but not least, Dr. Niklas Tsakos, CEO and founder of Tsakos Energy Navigation. There he is. Just this opening slide, which will show up on your screen, contains some information as to where each company is listed and the different ticker symbols. This webinar will consist of a roundtable discussion with the panelists I just mentioned, and it will last for roughly 1 hour in total, with 45 minutes allocated to panel discussion and the last 15 minutes for a Q&A session. So for that Q&A session, participants and listeners can submit their questions through the Q&A button at the bottom of your screen, and we will go through as many of these as we can. Please also note that Capital Link will be conducting 3 polls during the webinar, which will be strictly used for informational and educational purposes. We would
don't poll who's the better looking one, because of course we are in a very bad competition here. We give up. Paolo wins hands down. Bravo.
No. But before we begin our call, please note that this discussion is strictly informational and for educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. And then in terms of further disclosure, Capital Link is the investor relations advisor to several of the participating companies here at this webinar. And also myself at Fearnleys Securities do cover several of the listed shipping companies included in today's webinar. So with that out of the way, I think we can start off. And just before kicking off today's webinar, it's important to kind of see where we are in both the crude and product segments, just to give some very short background to where we are, following an impressive second half of 2022, where spot rates for product tankers went to all-time highs, crude went to near all-time highs. 2023 has been impressively strong as well. And at the moment, rates are holding very, very strong levels, particularly on the product tanker side, maybe now that we're heading out of refinery season. And this has obviously also been reflected in equity pricing. If you just bunch all the market caps for the panelists here today, they are up over 260% since the start of 2022, or over the last 24 months alone. So where are we now, and where are we going this winter? I think we can start off with the question maybe to Lois, as you have a mixed fleet of both crude and product tankers. Could you just tell us where we are now in terms of rates and the difference between crude and product tanker rates at the moment? Are we already at the winter seasonal highs, or do you think there's still some more leg to go this winter season?
Starting with the smaller ships, and really, we've got over 30 MRs on the spot market at present, and the rates are just very, very strong. You're with a fleet of that size and participating in a pool, you're both east and west, but with the west just being particularly strong, with diesel under high demand and really pulling, and the east rates starting to improve to follow that. we're seeing, you know, if we see these rates, we don't need more on the MRs, you know, we're earning extremely well, right? So steady as she goes there. It's just, I looked at, you know, what we booked in the quarter to date, and I was like, oh, and I heard myself say, wow, that should be even higher, you know, and I thought, wow, you know, Lois, come on, you know, when you see MR rates for a period of soon to be 2 years at $30,000 per day plus, that is just incredibly strong across the board. And then when we go up to the middle part of our fleet, you know, we've got Panamaxes, Aframaxes, and Suezmaxes, as well as these. The mid part of the fleet is earning as well as the VLCCs are. And it just really helps to have a balanced fleet at the moment. The Vs have added some to their rates as well. And then we've seen strong Suezmax and Aframax and Panamax rates. So, you know, we will post a strong fourth quarter, as I'm sure the rest of the panelists here will feel as well. But for us, having the diversified fleet, you know, as most of us do on the call, you know, it really has proven itself in this environment where inventories are still tight and markets are tight, and small movements cause a big response in rates.
Thank you, Lois. And as you say, several of the panelists here, they do have a mixed fleet. So maybe if I kick the next question over to Paolo, more product tanker focused, obviously. Do you foresee any, you know, different, call it rate dynamics between the product and the crude space in the short term, now that, you know, we are going out of refinery maintenance season? Does that mean maybe that you'll see more locally produced crude oil going into local refineries and seeing more product on the water in the short term? Or is there something else happening in the market at the moment?
First of all, I totally agree with Lois. I mean, she did a fantastic opening, and I thank her very much. We are certainly enjoying a very strong market, and I don't really know the dynamics between the clean and the dirty. I'm so much in clean that, but what we will see is that, to my mind, we are at the starting point of a winter market, because we had the maintenance over October of the refineries. And I don't know about you, but at least up to here in Italy, the climate has been very mild up to last weekend. So we are start suffering the cold only now. So there are elements to make us thinking that the market in front of us, at least for the winter season, has really still to start. And as Lois said, we are running at $30,000 a day. So I think the expectations are quite positive. We have to say, let's say, on the dark side of a coin, that yes, there is some economic slowdown. Of course, we have to admit that. But for a matter of ton miles, for a matter of positioning of the fleet, for the factor that the Panama Canal, basically for product carriers, are not possible because it's totally monopolized by the container people. And this is creating really the fundamental for a strong market to come. So I'm extremely positive about that. And we are seeing, as far as refining locally or in distance, but we are seeing now a lot of diesel coming out of India and coming to Europe. So these are long trips, and will absorb a lot of LR2s and LR1s.
Understood. And, you know, with that, you know, in mind, maybe that we still have the seasonal high in terms of freight rates still ahead of us. Maybe I'll kick the next question over to Lars. You guys in Frontline have recently, or you're growing the fleet. You know, it's going to be a massive fleet now that you get 24 VLCCs from Euronav throughout the quarter. The big, call it, or one of the big factors there would potentially be a reversal of OPEC cuts. Now, the meeting has been delayed. Today there was more news that it might be delayed further. What are you guys' view on, call it, the oil market balance at the moment? Can we, or do you guys expect some kind of reversal in the short term, or is that now more of a 2024 story, do you think?
Oh, it's obviously very hard to guess, I must say, because I think it's a high stakes political game that's being played around OPEC right now. But they have been kind of fairly well coordinated to try and achieve oil prices in the region where we are right now. I don't expect any fireworks, to be quite honest. I think they will probably maintain the cuts at the levels where they are. But obviously, you know, who knows? I think the OPEC story is a bit of a twofold one. So one is obviously more volume in the market will depress the oil price, but also increase. So basically lower our fuel cost, but also increase the overall volume. But we kind of like the ton-mile effect we've seen of particularly Saudi being kind of one of the most generous cutters in this kind of game, which has allowed kind of us to transport oil from all the way from US and Brazil and Atlantic Basin. So I'm not you know, like when Saudi decided on their kind of voluntary cut and Russia followed on their exports. You know, although the headline was seemingly negative, it actually proved to be positive for the bigger tankers. And we are, incidentally, if you ignore the MRs, we are incidentally now in a more normalized market where the VLCCs are actually the, you know, earning the most, and then Suezmax in the middle and the LR2s hovering $30,000 a day. So it's so I like to say that this is more like a normalized market. And again, on your question, you know, who knows what OPEC will do, but I kind of the likely scenario is that we won't have too much fireworks coming from them.
Understood. And does that mean, would you say you still have potential for higher VLCC rates throughout this, call it, winter season, or is it more peakish compared to products?
No, I think, you know, we kind of, the market is fairly firm as we speak, and it's actually very, very active. What I'm more worried about is the pricing power we actually have in this market, because it seems like most people are, you know, sufficiently kind of content with earning $65,000 per day. And you know, Middle East as a loading region has historically been kind of the you know, the price discovery place for freight. Regretfully, there are so few spot cargoes there right now. It's all kind of either being lifted by COAs. It's kind of you know, actors that don't necessarily have the same motivation to get freight rates up as we as a pure owner would do. And so it's kind of lost a little bit of its power as the pricing center for VLCC freight, which means that you know, we need to rely on US Gulf, Brazil, and West Africa to actually price freight. But I must say, just you know, we're actually a little bit disappointed that with the amount of business and with the amount of volume being done right now, that we're actually not move the market firmer.
Okay, understood. And if I switch gears a bit and move over to, you know, this question can actually go to both Nicholas and Ted, which, you know, you guys have more diversified fleets, and are you guys looking to, well, before we step into the supply side of this space, which is why everyone's bullish on the story here, given where demand is now, both in the short term and longer term, are you looking to increase your tanker exposure relative to other segments? If we start off with Nikos, for example.
Well, we are not yet as diversified as that, although there are members of our board of directors that consider coal as energy, so they would like us to get into the dry cargo sphere, which of course this is something we might consider. So we are very diversified, like the previous companies, you know, do anything from VLCCs down to MRs, and including half a dozen shuttle tankers, mainly Suezmaxes, Aframaxes, and surprisingly even Panamaxes that a few companies still order or operate. So we are diversified on the energy sector, including, of course, the LNG side. Yes, we are feeling. I feel that the market has legs. We are looking to renew our fleet. In the first part of the year, we sold up to 10 of our oldest first generation vessels. The majority of the ships we operate, and I'm sure like most of our peer group, we have built for our own use mainly in Korea and Japan. So it was a nice surprise to be able to have a hefty capital gain by reducing our first generation ice class vessels and selling them almost at the same price we built them 15 years ago. And we're looking to replace. Yes, I mean, we will maintain. We have already ordered at least 4 of those ships as replacement. We're building Suezmaxes, shuttle tankers. So we're very committed to our business, and we're looking at opportunities if they exist in this modern dual fuel second-hand price. So yes, I mean, we are committed like the others in the peer group in the business, and I think it's a good time to take advantage and renew our fleets. But we've been around for 30 years as a public company, and we do not think. And we will continue doing so.
Understood.
Sure. Well, we have a diversified fleet in containers and dry, but that's not in question today. Our diversification is like others between the crude and the product. We came in through the crude, but we were drawn into the product for a macro trend that's been starting for many years, decades actually, is this ton mile issue, which has now been exacerbated. So I think we've sold 7 tankers, and we've taken on 10 new buildings, some LRs, some MRs, LR2s. We've been able to, it's amazing. Are there rates coming? I think so. I think some of the, as we'd say, the shorts, the energy majors, major oil traders, we've been able to take some new buildings at obviously some high prices, but able to put them out at well above 20-year averages for 5 years out. And that's happening across the board, as you can see in the industry. Everybody sees the numbers going forward. Certainly on the product tank, there's a little bit more order book, but when you take an overage, boy, on the crude side, especially on the Vs, if you have a utilization rate of, I don't know, 30% on ships that are over 18 years of age, the Vs are going to have to, the crew's going to have to follow the products in terms of going over those 5-year averages going forward for new buildings to come in. And I think we're there to do deals if the deals make sense. You can do deals in any part of the market as long as you're smart about it. But it's higher for longer here across the board.
Yeah, and that kind of, if we following up on that, obviously talking about the supply side, which is much easier to analyze than the demand side in this market. It's probably fair to say that the tanker segments, both crude and product, considering trickle down economics between the segments, etc., has never really had the better backdrop here. Typically you only talk about shipping cycles in these commodity related segments being up to 2 years because you can basically build the segment to death, right? Looking at phase out capacity and all this stuff, how long does anyone here tend to look at this potential upcycle? For how long? For how many years? I guess it's an open question to anyone who wants to answer.
I'll just jump in there, and I'm just looking at the Fearnleys' own numbers. The two points I want to make. One thing is, we're having some kind of ordering and some activity and some new buildings coming, both on the speaking of the asset classes that we're exposed to on the LR2s and on the Suezmaxes, but absolutely very little happening on the VLCC side. And I think number one, speaking of the LR2s and speaking of the clean market, I'm kind of, as Paolo alluded to, you know, these long ton miles, and Ted was also kind of, you know, having the same point on this ton mile story. What's going to be very interesting going forward for the next 6 months is that we virtually have no VLCCs, new buildings coming into the market. So we have like 2 VLCCs and 5 Suezmaxes throughout 2024. And we all know what these guys do when they come out of the yard. Same with our own ships when they came out last year. They do diesel to the west. So it's going to be very interesting to see this winter season, kind of how that, you know, how that market will react. With regards to the longevity of it, you know, we have yet to see, or maybe inform me if I haven't kind of caught it, but we haven't really seen a Korean, you know, large tanker order for ages. It's China and potentially some Japanese yards that can do that, but you know, we're almost stopped talking about 26 now, and now we're talking 27. So obviously you will have berths that are available here and there in 26, but to do any kind of significant change to the supply side picture here, we're talking late part of 26 and 27.
Yeah, and just to add on that point, right? That could really become a big problem down the line, right? Because I think now you have to pay, you have to wait until 26, 27 for a VLCC, and for a Korean, Japanese, you pay $125, $130 million, and then you probably have to pay, I don't know, you guys know this better than me, but 10 to 15% on signing, right? And then, you know, with interest costs where they are, and you have 3 to 4 years lead time on that asset, that's hindering shipping. But how much would you guys say propulsion uncertainty and, you know, 25-year lifetime post 2027 is going into that equation as well and further hindering shipping? Is propulsion a big, you know, uncertainty when you're going out to order a ship compared to these segments such as containers and car carriers where you're closer to the end consumer? Is this a big thing here as well, hindering ordering? Because maybe, as you're here.
Yeah, well, I mean, for us, it is a significant deterrent of ordering ships. We have traditionally ordered mostly ships either for replacement or with long-term charters. We are working on dual fuels, and we have ordered dual fuels vessels with coverage with quite a long coverage period in order for us to be able to achieve this. So I think it is a big deterrent. If that was not around, I think the Chinese yards would be, you know, putting vessels into the market in the VLs from the VLs always downward. So I think for us it is very it is a deterrent, and I think it was proven that the market can move quickly. Going back to the double design, when the double design was actually officially implemented after the OPA 90, the owners you know, build and finally overbuild. I think this will happen, and because history sometimes repeats itself, I am worried the last crash we had was in 1929. Perhaps 2029 would be when we have to be careful for.
Well, I would say every one of us, you know, when we contemplate new building contracts, we have to make that project bear the cost of, you know, either dual fuel now, dual fuel later. What does that look like? Maximum flexibility. And of course, overlaid with what is the total projected consumption curve, you know? So, you know, the later you're getting a vessel, the further you are into, you know, okay, plus 25 years on that vessel's life. So, you know, we move oil with oil. And so we, by definition, have an additional existential factor that has to get overlaid into our business. And, you know, hopefully we're at maximum tanker supply today.
Yeah, I agree. Go ahead.
No, I agree. I think the honest answer is IMO has saved us from ourselves. The book may have been doubled without it, but I agree. I mean, the dual fuel seems to be with LNG is the intermediate fuel. Find out what the next fuel is. It's going to be a combination of a number of things, I think, going forward. But for now, I don't see anybody putting in some big orders at this point. I mean, regulatory issues and financial environment is very different than it was a few years ago. That in itself is also a deterrent.
Yep.
Just to add one point to that, because and some of you are exposed to these asset classes. The thing is that in the tanker space, apart from a very, very few, there is none of our clients are really willing to pay for this technology. I think kind of for the container business, say Nike, they're willing and they can actually get paid in one way or another for having kind of the green shimmer on the sneakers that are sent from China. We see on the car producers that in the car carrying industry, you basically you're bound to look at a more efficient propulsion because they need to kind of stamp their cars in that way. But in our industry, transporting hydrocarbons, you don't really have any clients that are willing to, at least not yet, that are willing to pay you the increment to make sense of the investment the owner needs to make.
Yep.
Lars, as we age in place with the existing fleet in the world, then that could get interesting.
Yeah, I did some if you do some simple, back of the envelope math I did before the seminar, if you just look, because this is my point, you're all saying you're never going to order ships at these prices, or never say never, but not at the moment, at least, with these prices and where rates are, etc., etc. But if you look at the global tanker fleet and how much, and you take into account that typically they're scrapped when they're around plus or minus 25 years old. If you look into 2027, which is basically the next year, assuming everything goes into tankers, you can build the market to death, so to say. Obviously very positive, that's in 4 years time. But let's say we go there, and that's where you have open yard slots. Over, or roughly 7% of the fleet will be over 25 years old. So that basically removes the entire, call it roughly 5% order book today just for renewal. And then if you go into 2030, right, you have 20% of the fleet being over 25 years old, or just shy of 20%. So, and then you combine that with that absolute oil demand is expected to grow. Ton miles is expected to be positive. Overall, this leaves a very, positive backdrop for the tanker space and having ships on the water today. But do we have to go to a place where ships have to sail longer than 25 years to be able to accommodate demand, or is that not happening due to regulations coming as well?
Well, I think you're already, first of all, the reference to 25 years is, is basically because you did, when I saw your email, I checked and there was like one ship scrapped this year. So it was 25 years old because it's been trading Iranian crude. So I would actually put it much closer to 20 years, to be quite honest. I think kind of in the normal scrapping year where you have some liquidity, it's around 21.5 years or something. But also the threshold right now, at least in the tanker business for crude, is 20 years. That's, any ship above 20 years is very hard to get fixed. On the clean side, if you have really kind of high grade refined products, you're actually talking about 15 years. So it's so kind of the picture looks even worse than what you're describing, right? But I absolutely think that if we should believe in oil demand continuing to grow as some do, well into 2035, we will need to trade the ships longer. But in order to do that, it needs to be economically feasible to do so. And obviously at $50,000-$60,000 a day, you don't really have that many incentives to spend a lot of money to extend, say, the lifetime of a vessel with 2.5 years. Rates needs to be a little bit higher than that, I think.
Just to jump in and say that there are a lot of good quality, and I agree with the time span that you have described, and there are a lot of good quality vessels that have been built during the last new building boom, which was between 2005 and 2010, when I think we overbuilt the market, and those were good quality double ships that can prolong operationally for at least another couple of years. And I always get pleasantly surprised when I visit, and I try to visit vessels at least on a monthly basis to see, those ships that are already 15 years old, and they look, and I'm sure the whole peer group that is here is operating in the same level. Vessels that could have been out of the yard just a couple of years, and they're 15 years old. So there are good quality ships built in amazing yards at the time. Between 2000, when we overbuilt the market, I guess it's the 6 years between 2004 and 2010. I think we all overbuilt the market in amazing yards in Korea. Very little Chinese content at that period of time, and Japan. So those ships are out there, and they can prolong for another couple of years.
Plus, we're down about 40-50% in terms of yards capacity right now.
Thank goodness.
No, yeah, that's right. It may jump up. It may go up a little bit. I mean, you see some yards open, but I mean, who's going to be taking VLCC from a yard that's just come about? I don't see that. Remember, even without scrapping, CII, EEXI, and all those other alphabet letters are going to slow down the fleet. They're going to do retrofitting. So you're still stretching the fleet even without scrapping. And so I agree with Lars. I think the numbers just aren't there yet on the crude side to get these longer term deals. But I mean, it's happening on the product side. You're well over 20-year averages. The 20-year average for the Vs from the time charters is probably around 40, and you're going to have to go well above that. I mean, it's a different environment for now. It's not the time is different, but it's going to, we're going from a short horizon to a longer horizon. And any bull market climbs a wall of woe. And I think people outside the industry are just thinking there's some short-term deal because of the war and other things. But, the macro that is oil's coming from the new discoveries from the east is going west. Same thing with the refinery issues. There's a whole bunch of issues that are macro that have been put in place and will continue in place for the next few years without supply coming on.
Oystein, when we look at the yards, they really have not made the type of money that they were making in the mid-2000s. Arguably, they've made very little money in the ensuing more than 15 years by now, where it has just been brutal. And you see Korea importing labor. You still see a very tight labor situation. Steel prices are fluctuating, based on Chinese demand, and we have to watch that carefully. If you're running a yard today, and a lot of these yards were being supported by government banks and had to be restructured, and they went through even more arduous period than we did in the tanker world. So, hopefully, we are a cyclical industry, yes. And, you can't say it's different, but it can be challenging, and you can have some of these, yards and ship owners where, even on this panel, most of us have either invested in new vessels and or, acquired them as Frontline has. And, you see that exposure, but you see it, in either a consolidation way or in a real fundamental reduced scale way, where you're not seeing, I think, the same type of big splash that you would see in previous cycles.
Yeah. No, I just, one last question on a question we get a lot, at least from investors, is because, assuming everything goes fine in the world and oil demand continues to go up, you see that most of production and demand is east and west of Suez. So there's a positive ton-mile story as well over time here. So it's the supply side, but yard capacity, again, as Ted mentioned, it's down quite dramatically since 2008. And when you can buy or order a VLCC for $130 million, obviously a bit less in China, they are starting to make some margin at least. But what we saw last time was that you saw shifts going up to 24-hour shifts, etc. Are those kinds of trends coming back, or is it very true that you have a massive workforce problem in Asia as well?
No, you're exactly right. The old the joke that all of us are talking about is, you find a welder in Japan, he's got to be in his 60s.
Yeah.
So there is a labor force issue going forward. And just this point about peak oil, even the one organization that talked about peak oil by 2030, it's not a cliff. it doesn't come off at all for the next 10 years. So I was just not sure. It's a good headline, but the way the world's going at this point, I mean, listen, I'm here in the States. We've got a lot of energy companies, oil companies. They're really looking at carbon capture, right, and LNG. So there's a whole bunch of issues that make it look like the oil will probably, 2 years from now, who knows how the world's going to be. But it's what you don't expect that's going to happen, and it's going to be a combination of things. We watch the airlines here because they're subsidized. They're leading fuel of the future is biofuels. They have a spacing issue, obviously. So who knows what's going to happen? But I think again, this whole issue of the next fuel is really put a cap on construction, and I think it's going to. I don't see it changing in the next 2 years.
No. And we are, before we head into Q&A from the audience there, maybe let's talk a bit on, most of you guys are spot, highly spot exposed. As Lois touched upon earlier as well, time charter rates, at least in the product tanker space, is pretty strong. Paolo, if we start with you, how are you guys viewing, taking, one question I get a lot from investors is that when rates are high, at least last winter, you saw time charter rates going through the roof as well. Why not take more coverage, even though you are very, very bullish on the long-term story here? As it could be a one-off. The world could turn heavily next year if you get the full-on recession. What's your view on increasing coverage?
I think that we will, let's say today and up to all 2024, we are covered by 1/3. So we are 2/3 on the spot. And we covered the type of ships which are more, let's say, not difficult, but let's say they more sensitive in certain situations. For instance, we have a number of Andes, and we covered all of them. And we are keeping most of our MRs spot and the VLR1s spot. We have just one that we covered for 1 year. The idea is to enter in 2024 and to increase that coverage. So certainly we will be looking to improve that. But we still think that it makes a lot of sense to be spot for at least this winter with a big part of the fleet. And talking about new building, I would say our idea is to wait to 2024 to understand also these orders, where they are going. Are we still going to see all these container ships ordered? Are we going to see still all these LNGs ordered? I mean, what is going to happen? Because considering that the yards are, let's say, they start worrying 2 years before delivery date, and if delivery date is 2026, 2024 will be the year where you can have a game changer or not. I don't know. So I think it will be important to see what is going to happen. Say that for a moment, yes, we are bullish and we are playing this way. We hope to be right, of course.
Yes. And anyone else have a different view on taking coverage in terms of being more spot oriented, short term and long term at the moment?
Well, we just came up with our, I think about 2 weeks ago with our 9-month results, and I think we mentioned there that within the year we have renewed or got new charters on 26 out of the 70 vessels. So I mean that, and all of them almost at significant premium from their previous time charter. So we are, I would say, 50-50 because we do a bit of or a significant part of profit sharing with our clients, and I'm sure others do also. So if you take the days, we are, I would say, 60% spot, 40% fixed, but we are not shy. But I think for all of us, when you have long-term clients and they're offering a 2 or 3 year employment in something that would have looked very, very attractive in 2019 or 2020, it's hard to let it pass. So from our side, we have extensively renewed, but everything with a 3 year horizon. going forward. So if someone offers us a very attractive rate for a year, we would accept something for 3 years that is also attractive, and it gives us visibility of earnings going forward.
I agree with
Understood.
Nick. Sorry, go ahead.
I think it's also important to note that you know, even though we're a very rich ship owners, we're actually exposed to interest rates. So to have return on capital, that you know, it kind of increases a little bit you know, what we need in order to have to you know, to butter on the bread. So I actually, you know, we would be very willing to you know, put parts of our fleet out on time charter, but right now we remain spot. You know, just looking at the fundamental picture and the proposition, at least we believe lies out there in the market. I think the charters need to pay up a little bit more before they at least get our vessels.
Yeah, certainly on the VLCCs, you know, it seems to me that there's more room, significantly more room for the Vs to run and to kind of, you know, as I use that term, age in place, and you don't have deliveries in 24, you know, I think that there's a lot of, you know, you're coming from a much stronger base rate now, and you've got more potential upside because it's a much tighter utilization than what we've seen.
Yeah, same with us. I mean, mostly we arbitrage the time charter market, although we have MRs and pools. We have half our VLC's fleet of, we have 11 Vs, 5 or 6 are on the spot market. You know, the idea for us was always to protect the downside, do time charter. The probability of taking whether it's a V or an MR1 or MR2, putting it out for a year and it coming back next year in a market that's worse than today is very small. So we're comfortable with doing a shorter term time charter and doing longer term time charter. Again, us and others have done longer term time charters on vessels delivering 2 years from now. So that's very optimistic on the product side. I mean, it means that, you know, the shorts have taken a portfolio approach, right? They went 10 years with playing the spot market and making tons of money off of that. Now maybe they had 5% on long-term charter just in case something would happen. I'm assuming from the phone calls we're all getting in from them that 5% went to 20%, maybe 25% on a long-term basis. That's really moved the market. And so it also helps the weaker owners, smaller guys who have mortgages, they want to put it out, they don't know, they'll take the first rate. I think it's strengthened and lifted, you know, a rising tide lifts all ships, and I think that's what we're seeing.
Yep, understood. And that kind of is a perfect segue over to something else. But I think, you know, the gist here at least is that most of the, or pretty much all the panelists are very positive to the market, and you will maintain some spot exposure. But before we run into Q&A from the audience, I would like to open the Capital Link poll. As should be up in your screens. There should be 1 to 3 questions for the panelists as well. Feel free to answer, and I'll give you all 30 seconds before we continue with the webinar.
Trying to click, but I realized
I think I just saw that panelists can't.
Vote times 10, Lars. Put in 10 votes.
Favorable.
Oh my goodness.
Okay, I think it's time to move over to the Q&A session. There has been coming in quite a few questions here. I'll try to, or here we have the poll results as well. I'm not sure if everyone can see them, but for the first question, 85% was voted for favorable. For the second question, sorry, that was for the second question, meaning do you expect product tanker sector to be, or how the outlook is for 2024? For crude, it was 81% saying favorable, and no one said negative almost. Pretty much all were on neutral other than favorable for both questions. And what will outperform in 2024, crude or product? 41% was for product, 28% for crude, and the remaining 32% for both. And then the main risk to tanker shipping, 42% saying demand. As expected, a very low answer for order book, around 8%, and the rest spread out pretty evenly, with also 47% answering geopolitical risks, which we do have at the moment, obviously. Okay, so with that, we'll move over to the Q&A session. And I think this first question is probably a bit more open-ended to any of the panelists here. There's a couple of questions. What is, or what are we worried about that we shouldn't be worried about as investors? And what are we not worried about, which we should be worried about, which is probably a good question to any of you guys that has been in this sector a lot longer than some of these new investors in this sector. So I'll give that openly to anyone who would like to answer.
I can try and have a go. This is like unknown knowns and all that stuff. But I think what some are worried about that we maybe shouldn't be too worried about is, obviously if we have a flat out COVID event in the world economy, I think we should be worried, of course. But if we have like a normal, bang like 2008, it's not normal, of course, but it's it's a fairly violent financial kind of event. Then we should be comforted by the fact that at that time the overall tanker order book stood at 45% of the existing fleet. Now it's around 5 or 6% of the existing fleet. So it means that we are not going to stay in the valley of below OPEX earnings for 3 years waiting for this mountain of ships being delivered. What we are not worried about that we maybe should be worried about, and I think this is, we're seeing at least from Asia that demand is keeping up surprisingly well. But it's completely it's not completely, but it's a bit against, the economical development, in particular in China. I think that's potentially somewhere where one has to look, because it's such a big driver of transportation, actually in all asset classes, that's something to watch.
Very good point. There could be some destocking risk there with inventories now being over 1 billion barrels, I believe, as I've seen some report at least. So that's a very good point. Then there's another couple of questions on potential market effects. I'll shoot this to anyone, but let's start with Ted. The Middle East crisis at the moment. What's the impact on the tanker market?
Actually, it's better, I think. It makes, if you're talking about OPEC and Saudi's cutting, it's being replaced by, longer ton miles coming out of the Atlantic, right? U.S. Gulf and Brazilian sites. But the Middle East crisis right now is localized. If you would have told me this was 30 years ago and the U.S. was where it was in oil, the price would have doubled on this problem. But because the U.S. is the biggest oil producer, it really has actually gone down. Remember, shipping, we're volume driven, not price driven. So if, say, the Saudis turn around tomorrow and open up their taps and everything goes to $60, well, the volume's better for us. If they stay where it is and we keep replacing the Middle East crude with Atlantic crude, it's fine. But the issue is the Suez Canal, the Straits at Yemen. I don't see the Iranians getting involved in cutting things off there. But the Suez Canal, there's about 2,000 ships a month go through, 500 of tankers. It could, I think it, unfortunately, we're positive on the market, but we wish for other reasons, right?
Yeah.
You have wars and you have issues.
Of course. Thank you. And I'll give this one to Nikos, as you have a fleet of not just tankers, but you have some LNGs, etc. What we've seen now recently, particularly in the LPG sector and VLGCs, is what's happening in the Panama Canal. Is the lower transit periods or lower transits through that canal impacting tankers at all? Or is it just other segments?
Yes, I think mainly the larger the larger vessels. Many of them are taking the view that it's worth going around, and so this way requiring significantly more ton miles. We're seeing quite a few delays. It's costing us, I think all of you know, a fortune, mainly for the LNGs to be able to. They have priority, but it's the most expensive passage so far in the history that we had for the LNG vessels. And I'm sure for Ted with his containers is feeling the pain also with the larger containers there. So I think it has created a small dent of 2 or 3% in increasing ton miles. That's our last estimate we had, but every little bit counts. Even that delay helps a very, very well-balanced market as the one we're having now.
Right. Just to stay on top of what Captain just said, I mean, he said it's a well-balanced market. If the overcapacity was 5%, these type of moves on the margin wouldn't move the market. But it's a tight market to start. And so that just goes to show you how tight the market is. And when you can have these huge rates 2 or 3 days later, and then maybe, okay, come down, but there's this tight squeeze. There's some tremendous pockets of strength in this market right now.
It starts to drive trade, right? Because you can bring product in. I mean, if it's going to cost you, the tankers at this point, we can't afford a $4 million. That's how much the freight is, right? To buy a slot, right? So, if you look at it, product can move potentially from the Far East to the West Coast as opposed to from the Gulf to the West Coast, and all of a sudden your calculus is different. So it drives trade. And when you back up and you kind of look at it, you see it from that lens.
Right.
Yep.
And all this pain that the charterers are having, pain drives the period market.
Yep.
But pain drives the period market.
Understood. And this question, I'll maybe throw this one to Lars, as you were talking a bit about it earlier. And I know you guys in Frontline are depreciating your assets over 20 years as well. So is, as you said, with 20 years instead of 25 years being the scrapping age, is there enough scrapyard capacity out there to take on all those ships that are turning 20 years old? Or what will happen to them?
Well, first of all, they're not going to be scrapped at 20 years, but the useful life, you could say, with the policies that our big clients are imposing, makes them pretty efficiently to stop, at least in the compliant tanker market, at 20 years. But with regards to scrapping capacity, that's actually one of the areas of expertise where I actually don't have much knowledge, I must admit. There is also regulatory aspects with that as well. With the Hong Kong Convention and the green scrapping and so forth. There should be a huge market for recycled steel. For the environment, it's much better to recycle it than to produce new steel and transport iron ore and blah blah blah. The whole kind of well to wake on the steel side. But what the absolute capacity is, I don't have a good call on, I must admit.
Pretty sure we'll get it sorted when we get there.
Probably. This, next question I'll maybe try to throw to Paolo, and anyone else feel free to chime in. But Paolo, what is being done in the sector now, or in the industry, to limit the dark fleet of what the questionnaire labels as money hungry operators running old and unsafe tankers?
I tried in a meeting with some oil companies, and I was there as chairman of INTERTANKO, and I tried to say, fix the INTERTANKO fleet instead of, and you are going to be safe and you are not going to face any problem. Of course, they have been looking at me, and the lawyer who was with me in that moment said, you cannot say that because this is against antitrust. So I had to shut up. But certainly, the dark fleet is a problem. The oil industry is very much worried about We expect some very some big accidents, and I'm being, of course, inflating more of a problem. Say, yes, you are at risk there, even if the cargo do not belong to them, but certainly it has been good for somebody who sold the ships to them in terms of ship value. But for us, yes, it's taking part of the fleet, part of the supply away, but also the demand, because the Russian demand we cannot touch it. So I don't think there is too much we can do. The only thing is to ask to port state control in the various countries, and China start doing that, to check this vessel better and to start acting against them.
Understood. Thank you, Paolo. And
if I can just add, I'm sorry for...
Go ahead.
Yeah, because we've been very vocal about this. I think,
yes,
and we've actually spoken to the IMO about this a few times. And I think it's kind of sad that the IMO, which is a UN organization, actually handing out the license plates for the tickets to trade in the compliant shipping world, at least, that we can't get something done with this, because luckily we haven't had, apart from the Pablo outside Singapore or Malaysia, we haven't had any major spills that we know of yet, but it's only a matter of time. And when you hear about the atrocity against seafarers and so forth, not getting paid, being left with the ship somewhere, also circling back to your scrapping question, my biggest fear is that if something really efficient is being done against this dark fleet, which actually the most efficient thing to do would be to allow Iranians to export oil freely in the compliant market, then people will just park these vessels and they wouldn't even bother to scrap them, to be quite honest.
Mm-hmm. Yep. Understood. And one, maybe one or two last questions there is that there was recently some news on Venezuela production coming back. Anyone here would like to tackle the question on what? Obviously, that will take some time, but they do have, production capacity, but you need to invest a bit. What would increased Venezuelan oil production obviously mean for ton miles and generally overall tanker demand in the future?
Well, let's see, first of all, if Venezuela keeps up with the agreement they made with the states about the open election. That seems to be in question. Yeah. Listen, I used to go to Venezuela when Navios was U.S. Steel back and forth. And this was before Chavez, and things were deteriorating then. I think you're going to get billions out. You're not going to get a lot of oil in the next year, so maybe a couple 100,000 max if you're going to get it. So they're not a big mover in terms of. I think we go back to the beginning. The OPEC issue is there's some African countries, Nigeria, Angola. Obviously, Lars talked about Iran. There's a whole bunch of them wanting to put more out. So this is what we have to watch going forward. Venezuela is just a sideshow at this point to me.
Mm-hmm. Understood. I think obviously there's several more questions there, but we are already over time. So with that, I would like to say thank you very, very much to all the panelists for a fantastic panel. And I think the overall gist here is that pretty much all of them are very bullish and still want to have some spot exposure at the moment.
Yep. Heading into the holiday season.
Exactly.
Merry Christmas. Merry Christmas.
Thank you.
Thank you.
It's my son's birthday today, so he's wishing you
happy birthday.
Happy birthday.
That's the handsome one.
Yeah.
He's enjoying his birthday listening to us talking about shipping, and unfortunately we were too bullish, so he needs an expensive present. So I have to go to 7-Eleven now. Okay.
Well, Nikos, Paolo, Ted,
Bye.
take care. Thank you.
Thank you.
Thanks, Lars.
Thank you. Bye.
Thank you.
Bye.
Ciao.